10 habits that are sabotaging your finances without knowing it. If you have experienced the frustration of working diligently yet struggling to achieve financial progress, this video will provide valuable insights for you. We will analyze the most prevalent financial errors individuals encounter and, crucially, how to transform those detrimental habits into strategic financial decisions that can facilitate the accumulation of genuine wealth. These insights extend beyond superficial advice. We are examining the strategies that significantly impact your financial future. It is advisable to remain engaged until the conclusion, as each habit is constructed upon the previous one. Please ensure you click the like button if you're prepared to take charge of your finances. And if you haven't subscribed yet, consider doing so for more insightful content aimed at enhancing your financial mastery. Consider sharing this video with friends who may benefit from its insights. It could serve as the financial awakening they require. Now let's delve into the process of dismantling those detrimental financial habits for the long term. Habit number 1, paying yourself last. Paying yourself last is among the most detrimental habits one can adopt. A significant number of individuals receive their paychecks and promptly allocate funds towards rent, bills, and entertainment expenses. They intend to allocate any remaining funds at the conclusion of the month. However, frequently, there are no funds available to allocate. This behavior perpetuates a continuous cycle of financial instability, characterized by reliance on each paycheck without achieving substantial security or growth. Wealthy individuals adopt a contrasting approach. They prioritize compensating themselves initially. Prior to engaging with any financial transactions or expenditures, they allocate a segment of their earnings specifically for savings or investments. This ensures that their financial objectives take precedence above all other considerations. Warren Buffett articulated a principle: do not save what is left after spending. Instead, spend what is left after saving. This guidance encapsulates the fundamental principles of financial discipline. Prioritizing savings as your initial expense ensures that you are actively investing in your future instead of depending on any remaining funds. Begin this practice by dedicating a minimum of 15% of your income to savings immediately upon receiving your paycheck. If that seems excessive, start with 5% and incrementally raise it as time progresses. The objective is to establish a system where saving becomes an automatic and essential practice, akin to the routine of paying rent or utilities. Habit number 2. Impulsive purchasing behavior. Impulse buying represents a significant risk to financial stability. Unplanned purchases, whether through adding extra items to your cart in-store or selecting Buy Now during an online sale, can accumulate rapidly and disrupt your budget significantly. Implementing the 24-hour rule serves as an effective strategy to mitigate impulse buying. When experiencing the impulse to acquire a non-essential item, it is advisable to pause for a duration of 24 hours prior to finalizing the purchase. This cooling-off period allows for a critical evaluation of the necessity of the item versus the possibility of it being an impulsive decision. It is frequently observed that the initial desire diminishes within a day, leading to a sense of relief for not having made the expenditure. Furthermore, it is advisable to refrain from shopping during emotional states such as stress, boredom, or sadness, as these feelings may result in suboptimal financial choices. Being more deliberate with your purchases can lead to significant savings, potentially amounting to hundreds or even thousands of dollars annually, allowing you to concentrate your financial resources on what genuinely holds value. Habit number 3. Attempting to maintain connections with friends who have high-end preferences. Peer pressure extends beyond adolescence. It persists into adulthood, particularly regarding financial expenditures. When surrounded by friends who frequent high-end restaurants, acquire the newest technology, or indulge in lavish getaways, one may experience pressure to match their lifestyle. Matching another person's lifestyle can quickly deplete your financial resources. It is important to recognize that each individual's financial circumstances vary significantly, and trying to replicate another person's expenditure patterns can lead to unfavorable outcomes. A study conducted by Bankrate reveals that nearly 60% of Americans lack sufficient savings to manage a $1,000 emergency, while a significant portion of these individuals maintains a high consumption lifestyle. The surface often conceals deeper realities, and frequently, individuals who seem to enjoy a life of luxury are actually relying on credit to sustain that appearance. To prevent becoming ensnared in this situation, it is essential to establish clear financial boundaries with your friends. Should you find the cost of joining them for an expensive evening prohibitive, consider proposing more budget-friendly options, or feel free to decline the invitation altogether. Being transparent regarding your financial priorities can prompt others to evaluate their own spending habits and may facilitate the development of deeper, more genuine friendships. Habit number 4, excessive dependence on credit card rewards. Credit card rewards programs may appear to offer free money. However, they can pose significant risks if not approached with caution. A significant number of individuals rationalize superfluous expenditures by citing points or cashback incentives. Nonetheless, if your expenditures exceed your financial capacity, or if you maintain a balance each month, the interest incurred will significantly surpass any rewards accumulated. Credit cards serve as instruments, and akin to any instrument, they require responsible usage. A common error individuals commit is relying on their credit card for all transactions, under the assumption that the rewards will ultimately be beneficial. However, a lack of caution may lead to expenditures that exceed what you would have incurred by utilizing cash or a debit card. It is essential to utilize your credit card exclusively for planned purchases that align with your budget and can be settled promptly. Consider a scenario where you intend to make a $200 purchase. Utilize your card to accumulate rewards, ensuring that you promptly settle the balance thereafter. This approach allows you to gain the advantages while avoiding the pitfalls of debt. It is advisable to refrain from using credit cards if you are unable to pay off your balance in full each month. Habit number 5, failing to monitor your financial situation. A prevalent reason individuals experience a loss of financial control is the failure to monitor their income and expenditures. Without a clear understanding of your financial outflows, it is probable that your expenditures exceed your awareness. This behavior may lead to questions about your financial status, despite earning a reasonable income. Monitoring your financial situation can be straightforward. Apps such as Mint, OneApp, You Need a Budget, and Personal Capital enable users to connect their bank accounts, credit cards, and loans, providing a comprehensive overview of their financial status. These tools provide a detailed breakdown of your monthly expenditures, enabling you to pinpoint superfluous costs and identify potential areas for reduction. For those who favor a more interactive method, utilizing a straightforward spreadsheet may be advantageous. I utilize a tool to monitor my net worth and expenses on a monthly basis. Monitoring your financial progress over time serves as a significant motivator and helps maintain focus on your objectives. Tracking your finances enables more informed decision-making regarding spending and saving. This method represents a highly efficient approach to managing your finances. Habit number 6. Developing a comfort level with debt has become so ingrained in society that many individuals fail to critically assess its implications. Many individuals perceive debt, encompassing student loans, car payments, credit card debt, and mortgages, as an inevitable aspect of life. However, it is important to recognize that the prevalence of debt does not imply its acceptability. Becoming comfortable with debt results in a relinquishment of financial freedom. interest payments significantly reduce your income, complicating the process of saving and investing for future financial growth. Initially, I perceived carrying debt as a minor issue, considering that nearly everyone in my circle had student loans, credit card balances, and car payments. However, after I resolved to systematically eliminate my debts, the situation transformed significantly. Begin by focusing on the repayment of debts. Prioritize the repayment of high-interest debt, such as credit cards, and refrain from incurring additional debt unless it is essential. Being debt-free creates additional opportunities, minimizes stress, and enables genuine wealth accumulation. Do not accept remaining trapped in the debt cycle. Dedicate yourself to breaking free from it. Habit number 7. Incurring additional costs resulting from insufficient planning. Being frequently surprised by unanticipated expenses suggests a potential mismanagement of funds. Forgetting to pack lunch and opting for fast food, incurring additional costs for rush shipping due to procrastination, or relying on Uber after missing the bus. These instances of inadequate planning can accumulate quickly. One effective method to prevent unnecessary expenses is to dedicate a few minutes each day to strategic planning. Engaging in meal prepping, assessing the weather prior to departure, and systematically reviewing your schedule can lead to significant financial savings over time. For instance, I frequently neglected to bring my umbrella on rainy days, resulting in the repeated purchase of yet another $10 umbrella from a drugstore. The accumulation of these minor unforeseen expenses resulted in a total of several $100s over the course of a year. Moreover, effective planning enables you to circumvent substantial financial setbacks, such as overdraft fees, credit card interest charges, or late payment penalties on bills. Implementing a degree of organization and strategic planning can significantly contribute to retaining a greater amount of your financial resources. Habit number 8. Excessive tax payments. Taxes represent a significant portion of your lifetime expenses. However, there are legitimate strategies available to minimize your tax liability and retain a greater share of your income. It is a common misconception that tax-saving strategies are exclusively beneficial for affluent individuals. However, this assertion is inaccurate. A variety of tax benefits exist for the average individual, provided one is aware of where to seek them out. Contributing to a 401k or an individual retirement account IRA represents a straightforward method for minimizing your tax obligations. These accounts enable investment using pre-tax dollars, which effectively reduces your taxable income. Furthermore, in the event that your employer provides a health savings account, HSA, you have the opportunity to make contributions without incurring taxes for medical expenses. Health savings accounts offer a unique financial structure that provides tax benefits at 3 distinct stages. Contributions are made without incurring taxes, the growth of funds is tax-free, and withdrawals for qualified expenses are also exempt from taxation. Understanding the available tax deductions and credits can lead to significant savings, and you don't have to be a tax expert to achieve this. Investing time in educating yourself on these options is essential. Over time, these strategies have the potential to markedly decrease your tax obligations and facilitate wealth accumulation. Habit number 9. Delaying the initiation of investment activities. One of the most expensive financial behaviors is postponing your investments. A common misconception is that a significant amount of money is required to begin investing. However, this assertion is not accurate. Starting early, even with modest contributions, allows for a greater duration of growth for your investments. The phenomenon of compound interest demonstrates how even small contributions can accumulate and result in substantial wealth over an extended period. Examine this scenario. Initiating an investment of $100 monthly at the age of 25 could result in a savings exceeding $200,000 by the age of 55, given an average annual return of 7%. Delaying the start until age 35 necessitates nearly doubling the contributions required to achieve the same objective. Starting early minimizes the amount of effort required in the future. Do not allow concerns about insufficient funds or uncertainty regarding investment options to hinder your initiation. Starting with low-cost index funds or utilizing robo-advisors can simplify the investment process. Initiating action at this moment is of paramount significance. The most valuable resource in the pursuit of wealth accumulation is time. 10. The absence of an emergency fund. An essential financial practice is the establishment of an emergency fund. Life presents numerous uncertainties, and the absence of a financial buffer can lead to significant challenges. Unforeseen costs, such as medical expenses, vehicle maintenance, or employment disruptions, can result in a precarious financial situation. It is concerned that a significant number of individuals lack sufficient savings to manage even a small emergency. It is advisable to aim for a savings amount equivalent to 3 to 6 months' worth of living expenses, allocated specifically to an emergency fund. This fund ought to be readily available, similar to a high-yield savings account, yet it should remain separate from your standard checking or savings accounts to avoid the temptation of using it for non-emergency expenses. An emergency fund contributes to a sense of assurance and enhances financial stability. This approach enables you to manage unexpected situations without depending on credit cards or loans, which may exacerbate your financial obligations. Initiate the process by allocating a modest sum each month and systematically increase this amount over time. Having a few $100s saved can significantly impact your ability to manage unexpected expenses. By identifying and modifying these 10 habits, you will be positioned to enhance your financial future significantly. Identifying these patterns is the initial phase. The next step involves implementing measures to substitute detrimental habits with effective financial strategies. If you found this video beneficial, kindly click the like button and subscribe for additional insights on effectively managing your finances. Let us embark on the path toward achieving financial independence collaboratively.